afternoon, everybody. First of all, I'd like to thank David Duffy and the Corporate Governance Institute for having me on this Lunch and Learn session on Finance Essential for Board Directors. So my name is Seán O'Reilly. I'm the Assistant Head of the School of Accounting and Finance in Technological University Dublin. I'm a chartered accountant, having qualified and trained in PwC. I am a PhD candidate, and hopefully, all going well, I'll be finished my PhD in the next couple of months, which is on the topic of entrepreneurial finance and financing for startups. I'm a FAE lecturer for Chartered Accountants Ireland. I'm the lecturer on the financial matters component of the diploma in corporate governance with the Corporate Governance Institute. I'm an internal and external examiner for some of the professional accountancy bodies. And I have experience as a company founder, director, and independent non-executive director, which also includes some international engagement. So I'm very happy to be on this particular session today. So I suppose, guys, just before we start, I'll talk through what we're going to cover in the next 20 or 30 minutes. So look, companies around the world have been working to create high-performance boards made up of directors with diverse backgrounds, not necessarily in accounting and finance. However, since accounting and finance drives significant proportion of strategic decisions that board makes, directors need and are expected to have a strong grip on finance and accounting to be effective. So I think it's really, really important for board members to have a good grasp of the basics of accounting and finance. So during this session, I'll provide a high-level overview of the financial reporting requirements, the primary statements themselves, management accounting versus financial accounting, followed by how do we identify red flags in companies in difficulty. And I think that's a really important part. We'll briefly discuss audit and the role of the Audit Committee, and hopefully we'll provide a basic insight for you into financial matters for board, but it's also a small taster of what we do in the Corporate Governance Institute and give you a flavor of this particular module itself. So first, I suppose we must be aware that directors' statutory responsibilities are to prepare proper books and records. As we can see from the list, and again, it's not an exhaustive list and it will vary by jurisdiction. And I know, as Paul said, we have a lot of people from different jurisdictions here. But when we look at the bottom two, directors must prepare entity financial statements under relevant financial reporting frameworks, and they must prepare directors' reports for every financial year. And they're the two main responsibilities from a financial perspective. So I suppose, why do we have to keep proper books and records and financial reports? Because we have to do so under the Companies Act. As we can see, there's a duty to keep adequate accounting records, which include correctly recording and explaining the transactions of the company, enabling at any time the assets, liabilities, financial position, profit or loss of the company to be determined with reasonable accuracy, enable the company's director to ensure that any financial statements of the company required to be prepared with the Companies Act, and where applicable, financial reporting regulation, that we actually prepare the accounts in line with the regulation and the Companies Act, and enable the financial statements to be properly audited if they are required. So again, we're just looking at the background really from a legal and a regulatory purpose first for just a minute or two, and then we'll actually get into the more interesting components. So in terms of financial reporting requirements, it's important that you guys as directors understand the financial reporting requirements and how they may differ depending on industry, the regulatory environment, by country, and according to the size of the company. So I'm just going to give it an example, I suppose, and apologies, it's mainly on an Irish perspective, but I know we will make reference to other jurisdictions as well. So from an Irish perspective, we know that the Companies Registration Office states that companies must meet 2 of 3 criteria to submit fully audited financial statements. And those criteria are that the balance sheet does not exceed 6 million euro, revenue does not exceed 12 million euro, and the number of employees does not exceed 50. If you breach 2 of those 3 thresholds, you must submit audited financial statements. So that's something to be really, really careful of if you're a board member and you're getting involved in a new company. Do they actually reach that threshold? Do you need audited financial statements? What are the benefits of having an audit? And there are a few things that we will look at later on. However, we know from a charity's perspective, different rules and regulations apply, but in most cases, all charities or publicly funded entities or entities who fundraise from the general public need to be audited. Okay, and I know in the UK, for example, in terms of charities, it really depends on the income level that they generate, and based off that, then they decide whether you need an audit or not. So again, that will be something to be careful of in terms of what jurisdiction or location you're from. In terms of the financial reporting frameworks, we have 2 major frameworks that people may be familiar with or may have heard of. We have IFRS, which is the International Financial Reporting Standards, which is set by the IASB, which is the International Accounting Standards Board. This is pretty much European-wide. It's, let's say in mid-2000s, a lot of the generally accepted accounting principles harmonized together. So we would have had Irish GAAP, UK GAAP, German GAAP, French GAAP, and they all merged together to create a harmonized international financial reporting standards. However, the US opt and work on something different, which is known as US GAAP, so United States Generally Accepted Accounting Principles, and that's set by the FASB, which is the Financial Accounting Standards Board. Why is this important? Because the boards that you guys will work with in the future or are working with now must comply with those financial reporting frameworks. I don't think any company in the world does not do that, really. That is the rules set down, so you have to do that. There's also additional regulation that you should be careful of in terms of what industry you're in. Is it the central bank? Is it the Financial Conduct Authority? There will be additional regulations depending on what industry your company is in. So I suppose, guys, now to the exciting part, and we're going to try something a little bit different here, I suppose, and we're going to look at the main elements of financial report. So today I'll give a high-level overview of the income statement, the balance sheet, and the cash flow statement. There are other statements, such as the statement of comprehensive income, which actually forms part of the income statement of changes in equity, and then the director's report, which is a non-financial qualitative report on the performance of the previous year, the future outlook, but it effectively forms part of the financial reports. So guys, what we're going to try and do, and I might call upon David Duffy, if that's okay. I'm going to ask you guys on the call, if you don't mind putting in the chat function, if you were presented with a set of financial statements and you're just starting a position on the board of a company, what are the key areas or what are the key headings that you guys will be looking out for from a financial perspective? So that could be revenue, it could be assets. Maybe just post into the chat what you believe is the biggest one that you should focus on. And I might ask David if you might come in based off your experience. David, if I was to hand you a set of financial statements, what are the key areas that you would look at? I think you're on mute there, David.
The first one would be a quick look at the balance sheet to see if it's plus or minus. If it's minus, it means, you know, the liabilities exceed the assets and you want to know why. And the next thing would be the cash position. You know, is it solvent or not? So any director who's thinking of going on a board needs to make sure the place is solvent. And the other thing I'd be looking at is major variances between the budgeted P&L account and the actual P&L account, and try to understand that. So if there's major variance on sales in particular, that'd be a worry. So those are just some points.
Thanks, David. We got there's a lot of comments in the chat function. So thank you so much for that, folks. And feel free to post in frequently during this particular talk. Yeah, some people have mentioned the profit and loss, revenue, and a lot of them, David, as you said, are looking at the cash and the balance sheet, and to really look at what is the cash position of this company. Are we solvent? Are we insolvent? Or do we have short-term cash flow problems? So that's brilliant, guys. So what we're going to do now is, again, maybe it's a lot to take on, but again, I know that there may be some people on this particular call that don't really have a background in accounting or finance. And while we can't cover everything in the space of 20 minutes, I'm going to try my best to give you guys a high level, what is in each of these statements and why is it important? So first of all, we'll look at the income statement. And guys, essentially, it's how much we have sold in a given period, 12 months, less any expenses we have. So this is just a typical maybe layout of a company. And we have 2016, 2017, 2018, as you can see there on the screen. So these figures are in millions. I'm just going to maybe make reference to them as I see them. So revenue 5,000, okay? So pretty much we have revenue, that's how much we sold, minus our cost of goods sold, COGS, that's cost of goods sold. That is the cost that's directly attributable to making and selling that product or service. Usually it's going to be a product. Most services will not have products that they have bought to resell. So we're pretty much looking at manufacturing companies, companies that buy goods, sell them on. Then we have our gross profit, and that's effectively the profit from directly selling that particular good. Finally, after that, we have all our other expenses. So revenue, cost of goods sold, gross profit. That's all in relation to selling a particular good, okay? Then we have other operational expenditures. So what are our other expenses? We have here depreciation, SG&A, again, a lot of different companies will use different abbreviations, but that stands for selling, general, and administrative expenses. So that's where you might have your salaries, your selling costs, accountancy fees, legal fees, and so on will be in there. Then we have our interest, which we will pay to the banks perhaps, earnings before tax, taxation, and then we have our net income or earnings. So guys, that's pretty much will show us a company's ability to generate sales, manage expenses, and create profits. So we should note it's prepared on the accounting principle that includes revenue recognition, matching theory, and accruals, which is different from the cash flow statement, which we will look at in a moment. So we may have sold €5,000 worth of goods, but we may have not received it all in cash because we buy and sell on credit. So that is a high level, 2-minute overview of the income statement. And it's pretty much to show how much we've sold, what are our expenses for that 12-month period. However, when we look at the balance sheet, it provides an overview of our assets and liabilities at a given point in time. So at the 31st of December, it's like a cutoff. What is the value of the buildings at that particular date? Whereas the other statement we just looked at was how much have we bought and sold in a 12-month period effectively. Now we're looking at what is it at a given point in time. So it's broken down into 3 headings: assets, what we own; liabilities, what we owe; and then equity, which is ultimately our net worth, or what have the founders or the directors of the companies actually put into the business, plus any retained earnings, which is effectively an accumulation of profits over a period of time. So what I'm going to do again, guys, I'm going to try my best to explain some of these key concepts in about 2 minutes. So it may be difficult, but again, that's where we have our chat function to answer questions later on. So assets, what we own. So within that, guys, and you can bring a lot of this stuff, you can bring it back to a personal perspective as well. Think of what assets do you guys have? So assets are broken down into 2 types. We have current and non-current, or we could call them short-term and long-term. When we look at current assets, it's effectively assets that we will use or that we can liquidate in a period of less than 12 months, less than 1 year. So within that, in this particular case, we have cash. So that's our bank balance. Well, obviously we know we have that cash there and we can use it at any moment. So we would consider that a current asset. We have accounts receivable. This is money that is due to be paid to us. We have sold goods, but we have yet to be paid. So of that 5,000 we just seen on the previous page, 2,000 we are due to get paid. Okay, and that's considered a current asset. And then we have inventory, which is also known as our stock, or if we're a clothing manufacturer, the clothes that we may have in our stock room, that's the inventory. So that would be current assets, short-term assets. And then we have our long-term. And that's effectively assets that we will use in a period of over 12 months. Property, plant, and equipment is probably the one that most businesses would see. We also have maybe intangible assets will be included in that. But within property, plant, and equipment, we could have buildings, motor vehicles, warehouses, medical equipment, devices, IT equipment, whatever it may be. And we know that we will use them over a period of a year. So therefore, they're classified as non-current assets. In terms of liabilities, then, folks, it's the same. We have our current liabilities, which is obligations which are due to be paid within a 12-month period, and obligations that are due after a 12-month period. So when we look at this particular example, we have our current portion of debt, which is due within 12 months. We have accounts payable. They're the suppliers that we owe money to. So we buy and sell on credit. So we actually owe our suppliers some money, and that's due within 12 months. Also, we look at our long-term liabilities, and that's our long-term debt. That's debt that we have to pay back over a 12-month period. In terms of equity, then, as I explained earlier on, it's broken down into just a few components. We have share capital and then retained earnings. The share capital is ultimately the money that the founders, in this case, put into the business. So we can see here it's 30,000 each year. So at some stage, they may have put in 30,000 of their own money, and that's considered share capital. The rest, that retained earnings, is made up of accumulated profit and loss over a period of time since they began trading. And that will be the balance sheet: assets, liabilities, and equity. It shows us what we own, what we owe, and our net worth at a given point in time. Finally, and as David alluded to earlier on, really important statement: cash flow. And you guys have probably heard the phrase before, maybe cash is king. And it is, because we know that we could have sold a lot of goods, but we haven't been paid for them yet. Or we could be trading really heavily. We could be over trading, and we actually cannot pay our short-term obligations, or we cannot pay our staff perhaps, but we have sold a lot of goods. Well, it doesn't matter unless we get cash. So we should focus on three main headings here. And again, I'm going to try to explain these in the space of 2 minutes. So we have cash from operations, cash from investing activities, and cash from financing activities. In terms of the cash from operations, we can see at the top of the image that we have here on the screen, net income of 725. So that's taken from the income statement. We then have to make adjustments for maybe changes in working capital and the amount of cash that we've actually spent in order to generate that net income of 725. So when we look at it at the end, we may have made net income of 725, but in fact, it ultimately cost us 1,775 to generate that income. So our cash from operations is actually negative. So that's a bad sign. That will be potentially one red flag that we will talk about later. So our cash flow from operations is negative. The next one, cash from investing activities, we look at, well, what have we invested in during the last year? And that's usually fixed assets. Now, just to make you aware, on the cash flow statement, if it's in a negative or we have brackets around it, that's considered a cash outflow. If it's a positive, it's a cash inflow. So we can see here that this particular example, the company purchased property, plant, and equipment of 5,500. We may have disposed of equipment or whatever in other cases, but in this scenario, they've just purchased 5,500 of property, plant, and equipment. Finally, the last heading, cash from financing activities. How did we finance the last year? How did we finance the purchase of property, plant, and equipment? How did we finance the operations? And really, guys, it's going to be broken down into two components. For the financing people on this call, it'll be very straightforward: debt or equity. Did we finance it by bank loan? Did we finance it by maybe issuing shares? What is the case? Okay, so in this particular instance, we have been issued debt. So we know that this particular company has financed the 2018 period with 6,000 worth of bank financing. At the very end then, guys, we have an overall net change in cash. And as we can see from this particular year, 2018, the net change in cash is a negative 1,275. So I know some people mightn't have expected us to go through income statement, balance sheet, and cash flows in the space of 6 or 7 minutes, but I think it's important just so you understand what are the key statements and what is actually included in each of those statements. So I hope that has helped somewhat, and then hopefully it will help for the next couple of slides. So board members should be aware that really they will be reviewing regular management accounts. So what is the difference between management accounting and financial accounting? Because the difference is huge, and it's really important to note them if you don't know them already. So management accounting is internal. It's for internal use within the company. It's forward-looking. So it looks to the future. It looks at now. It's for the purpose of management to help them make decisions. And it's also quite informal insofar as the layout can be whatever way you want it to be. You can ask specifically for the board or for the financial director, financial controller, the finance function to prepare specific kind of management accounts on maybe different products, maybe different segments of the market that you're operating in, and you can get a really good breakdown. However, for financial accounting, it's for external purposes. So those accounts that we just looked at in the previous slides are published financial accounts that will be put out into the public domain. They're historical. They're looking at the past. They're primarily for shareholders and other key stakeholders such as customers, suppliers, government, people with an interest in the particular area, whereas the management accounts are only for internal, and they're only really for the company and the board of directors. They should not go outside of that area unless the auditors request them, of course. And it's highly regulated in terms of the layouts that we have to follow under the financial reporting frameworks. And I suppose, guys, depending on the type of the company, the reporting cycle, the resources available, board members should obtain management accounts on a monthly, bi-monthly, or quarterly basis. David, I might just bring you in there again, if that's okay for a moment, in terms of management accounts. Would you suggest, as a board member, if you were willing to, if you were asking for these accounts, how frequently should we be looking at them?
I think on a board, you should get them every month, whether it's a board meeting or not. So you know what's going on between board meetings. And obviously at the board meeting itself, maybe it's quarterly, the CEO or the CFO would be going through the accounts much more detail, but I think it's a good thing to get them every month so you're in tune with depending on the health of the business, if it's struggling on the cash front, you'll be paying a very close eye to see how it's doing cash wise.
Yeah, no, you're right, David. And look, I think now we will cover in a couple of slides, but I think the way that financial technology and accounting software has gone, there's no reason why you couldn't be getting it on a monthly basis. Of course, it depends. In very small entities or charities, they maybe don't have those resources. So that would be the only concern. But as David said, if you could get it on a monthly basis, that would be ideal. Okay, so what would be in regular management accounts really, or what are the key management accounts that we would be looking at? And really, guys, it's going to be budgets. And within budgets, we're going to have a number of different types. Operational budgets, cash flow. So cash, as we have said, is really, really important. Sales, production, labor, capital, overhead, and then ultimately they're all rolled in together for the master budget, which would be everything combined. But you should be able to get a breakdown as board members of each one of those different types of budgets, or you should be able to follow each of those if the accounting system is done correctly and the reports are user friendly, that you can follow it quite clearly. But really, guys, there's no point in having a budget unless we can compare it to something. And I know David made a really good point earlier on the key areas to focus on, or the key questions to ask as a board member. Variance analysis. What we have actually spent versus what the budget was. So that is of great importance, and it's something that we will look at in terms of a red flag. But basically, folks, what it is, we will have what we had planned to spend versus what we actually spent. What we had planned to sell versus what we actually sold. And that will give you a really, really good indication about how strong the budgeting capabilities are in the company, about how the company actually performed, and any key areas of concern. You'll also get future forecasts, of course, even further on down to the future. And you should be able to get condensed income statement, balance sheet, and cash flows. So you can kind of compare the financial accounts at the end to what is going on a monthly or bi-monthly basis. Now, this is the red flags. And again, there's a lot of different factors here. And again, I must say it will depend on the different type of industry, different type of company, different type of jurisdiction as to what different red flags would be. But being able to identify them can be very difficult for anybody, but in particular can be challenging for board members who may not see the full breakdown of the figures too often. It's really important to have access to the management accounts on a regular basis, as David said, and to ask the right questions if you believe there are any issues arising. We've seen a number of high-profile cases recently, I suppose, with Wirecard, the FAI, Ted Baker. I know on the Financial Matters module that I deliver, we cover Ted Baker in detail. And it's a really, really great case. The question always arises, well, what could the board actually do? Very, very difficult. Okay, so sometimes it's hard to actually spot them. So the above is a list which may arise. So unsteady cash flow. So if I'm looking at my budget, my cash budget, and out of nowhere, there's unsteady cash flow from month to month, that might be a red flag to look out for. The big one that David had mentioned, and I think this is probably the most important, is large expenditure variance against budget. So if we have planned to spend maybe 10,000 euro on a marketing budget for a specific campaign, and we find out we spent 50, that doesn't really look too good. We're going to have to look a little bit further and to probe and ask these questions and hold the guys accountable. Unexplained expenditure. So identify any large non-recurring expenditure. Again, if there's a once-off expenditure with no real reason for it, that will be quite concerning. So that would be a red flag. Increasing debtor days, which also ties into rising accounts receivable. So it may be a case that we're buying and selling a huge amount on credit. That's a big red flag, because are we actually going to get paid for those sales? Or have we just sold them to maybe inflate the income statement? And that's something that would be of huge concern. Are there sudden changes in working capital management? Have we suddenly bought a load of inventory? Have we suddenly sold a lot of inventory, or maybe returned it? What is the reason for that? A big one then will be the ability to meet obligations. So are we able to pay back the debt providers, the suppliers, or the tax authorities? Are we actually reaching our obligations as they fall due? Is there an increase in short-term borrowings? That will be another kind of red flag as to, well, why do we need short-term financing? Because we know it's very, very expensive to be financed out of maybe a bank overdraft, perhaps. But also, folks, there's non-financial factors as well. And a lot of people think that some of these red flags could be financial factors. But in some cases, it might be a case that key staff have left, or a new competitor has entered the market, or something like that. Or, we have had a very unsuccessful marketing campaign. they're non-financial factors that also should raise red flags, and we can link them all to the financial performance. Following on from this, I suppose, guys, is the going concern concept, which ties into
All right.
no worries, David, all good. Let me see, I've skipped a slide there. So the going concern concept, which ties into a company in difficulty. What are the telltale signs of a company in difficulty, or how could they be considered to be a going concern? So guys, a going concern is one of the fundamental accounting concepts, and it's for boards, it's for auditors, it's for everybody. And effectively, it is assumed that it will meet its financial obligations when they fall due, but can continue to trade into their foreseeable future. So all the financial accounts are prepared on the basis that a company is a going concern and will continue to trade into their foreseeable future. When might that not be the case? Here's a couple of examples. So if a company is continuously loss making, and I'm talking about 3, 4, 5 years of loss making, they may be considered, they're not a going concern. However, we know for startups in particular, high tech companies, if we look at Tesla, we look at Amazon, they lost a lot of money, but they still had so many assets, they still had so much going on that they weren't ever going to be considered not a going concern. However, there's other companies that will be continuously loss making, and unfortunately they will, they might have going concern issues. Negative operating cash flows, if a company is over trading, or they cannot fulfill short or long-term obligations. They would be some of the key signs of a company in real difficulty and that they may be considered not to be a going concern. However, not all warning signs, again, guys, are considered financial. So for a going concern, and while it's an accounting concept, if we lose key management or personnel, non-compliance of statutory requirements, new competitors enter the market, loss of market share, they're also going to be considered issues or factors that could impact on going concern. Unfortunately, at the moment, and from some of my discussions with some of the guys in some of the big firms, unfortunately, COVID is going to be a big factor in this in the next couple of years. And we see certain industries have really suffered. And unfortunately, maybe it doesn't look like it's going to end as soon as we may have thought. So I think COVID for board members, depending on the nature of the industry that you're operating in, is something that you're going to have to consider, and you're going to have contingency plans in place. You're going to have to look from a financial perspective. How long can we, have a contingency in place for, or can we set aside money, or can we redo something to make sure that that doesn't become an issue? So hopefully that will be the case. Guys, just a couple of slides and then we're going to hold it for some questions. Technology has revolutionized accounting and accounting practices really, and the role of financial technology, accounting software, and AI are really important for organizations. And as such, then it becomes essential for board members to have some knowledge on this. We'll talk about later of internal controls and internal auditors, but here's just a highlight of some of the key characteristics of a good accounting system. And that's another key question. And I'm surprised, I think maybe one person in the chat might have mentioned it. Who are your auditors? What accounting system are you using? Sometimes they are the key questions you would ask first before we even look at the financial statements to find out a little bit more. But the characteristics of a good accounting system will be obviously good analytical and reporting capabilities, be user-friendly, automatically updating, customizable, ability to share data. It is interoperable with other systems that we may have. Scalability and obviously security is going to be really important. And especially we know now there's been a number of cyber attacks. So you want to make sure as a board member that whatever the accounting and financial system that you guys are using, what's the security on this? I also think, guys, now more than ever before, it's so easy to generate data from the financial statements and from, the performance from month to month. So being able to have the system interoperate with the likes of Tableau and to be able to provide you guys then with a breakdown of data analytics makes it a whole lot easier for people to actually visually read what has happened. So that would be another tip that I would give you guys, that when you're asking for these management accounts, perhaps it may be a case of, well, can you show it in data visualized format so we can read it a little bit better? Audit. So finish on maybe the best until last, perhaps. So an external audit is an independent examination of the company's statutory financial statements as prepared by the directors of the company. Now, guys, this is the last slide we're really looking at, and it's a really important one and something that I would probably hope that David might be able to answer in a moment for me based off his experience. Audit committees. Really important. As we can see from the image on the right-hand side, audit committee has a connection, would say, or is interlinked with financial reporting, risk and internal control, internal auditing, external auditing, and governance and compliance. Now, I was fortunate enough on there was an educational trust that I am an independent non-executive director on, which subsequently has now become a charity a couple of months ago, but I set up an audit committee. Now, there's not a whole pile to it, as I might ask David in a moment, but their role is of great importance. And that would be something I would also hope that you would take from this particular Lunch and Learn session, the importance of an audit committee. And I know there may be some questions on this later on. The audit committee pretty much meet, I would say, from 2 to 4 times a year, perhaps, but they have a big role in, let's say, for example, here we see on the left-hand side, the selection of the internal auditors. What's the role of the audit committee in that? Well, they draw up the specification of audit and other requirements, such as tax or corporate finance work that they may have, develop and issue a tender based on those requirements, develop what the selection criteria will be for that particular company, invite the auditors then to pitch, and then decide on the successful tender. But really, guys, the audit committee also, as a board, have a link then to the internal auditors and the internal controls within an organization. And that's where you'll be asking these internal auditors to meet them, to perhaps say, what's the accounting system like? Are there any areas that you feel are, an area of concern, any areas of weakness? And I suppose then, while they look at the external auditing and the governance and compliance, that should be fine in financial reporting. It's really the other 2 components, the risk and internal controls and internal auditing, that I think are even more important, because we should be able to stop any issues that may arise. We should be able to raise red flags very, very early if we do it right. But we have seen from the financial matters module that I lecture on with the Corporate Governance Institute, we've seen some great feedback from a number of cohorts about the importance of this audit committee in figuring out if there are issues along the way and what the role of the internal auditor plays in an organization. So I think an audit committee is of huge importance. David, I don't know if you're involved in any audit committees. You'd certainly have experience of working alongside them, but maybe do you want to tell the guys what are the benefits of maybe an audit committee?
Well, I think the benefit of any committee of a board is to ensure that detailed work is done in particular areas, whether it's audit, risk, or nominations, or remuneration, and to take that kind of detailed work away from the boardroom table, and to let those with competence run an audit committee. So there should be detailed terms of reference, so it's absolutely clear what the role of the audit committee is. And of course, it should be chaired by a member of the board, but there also should be at least one competent qualified accountant on it. And that's really, really important, because he or she needs to be able to have a view on, in particular, the quality of the information coming through from the executive. And also, I think the role of the audit committee is to have a sense of how competent the CFO might be or not. So it's not just the systems, it's actually the people who are running those systems too that are important as well.
Yeah, you're right. Thanks a million for that, David. So guys, that pretty much brings an end to the session today, or the presentation, I should say. So once again, I'd like to thank David and the Corporate Governance Institute for having me involved in this particular Lunch and Learn session, and I look forward to any of the questions. Likewise, if we don't get around to all the questions, I'm happy to take an email or a LinkedIn message or anything like that if anyone wants to reach out. So thank you for that.
Great stuff. Thanks, Seán. So what I might do, we have some questions here. To get started, I'll ask you a couple, and we've some in from the audience too, so I'll get through them as well. So just to get things started, if there were a few key areas of the financial statements to focus on as a board member, what would they be in your opinion?
Yeah, look, that's a good question, Paul. And you know what, I think David really touched on that earlier on. And I suppose, I know I asked the guys on the call to type into the chat, which they did. But for me, I would always, when we put it in chronological order, and we probably open the financial statements and we would have the income statement. Well, that's pretty much how we perform during the year. So I want to know, how much did we sell and what's our profit? That would be a really key standout point for me immediately. But then we look at the balance sheet and see, well, what assets do we have? And then I suppose, as David really pointed out, along with a number of other people on the chat, what's our debt position? Do we have loans outstanding? How are we financed? What's our bank balance like? But then ultimately for me, if I could really narrow it down, and I know I'm probably answering too long here on your question, but the cash flow, really, really important. That will really give us an understanding of how we perform from a cash position during the year. And really from that, we will be able to tell a lot. So to summarize very, very quickly, key areas, how have we performed? Look at the income statement, revenue and profit. What's the structure of the business? We would see that in the balance sheet. And then ultimately, how have we managed our cash flow? So we need all the statements. And one other thing, Paul, I would just say to the guys, while we're just looking at these key areas, the notes to the financial statements are equally as important, because we can find out a lot more information and a greater breakdown. David, I presume you would agree with that in terms of the financial statements are great. They only tell one side of the story. We may have to dig a little bit deeper in the notes.
Yeah, so for example, you might see sales in the P&L account, but you need to know when revenue is recognized from an accounting point of view. We see a lot of organizations that are involved in big projects. They might recognize revenue too soon, and you have an inflated P&L account. You might not see the cash in it. And Carillion in the UK probably fell into that category, and they went bust as a result, where their finances look great because they're recognizing revenue, but actually they're recognizing revenue too soon and couldn't collect the cash against that. So be careful.
Great stuff. Just to let people know, the slides will be made available after the session, and a recording of this session is available for 1 week. Getting into a few more questions. So a question earlier from Roisin McGuigan. Thanks, Roisin. Roisin wants to know, would equity for a charity just be their reserves?
Yes, that would be right. Yeah. And that's another thing, guys, I probably should have mentioned earlier on. A lot of it, there'll be different words and terminology. So we would say equity, perhaps then it would be reserves and so on. It really depends on the nature of the business.
Thanks, Sean. A question from Sarah Paris. Is there a recommended finance short course for board members that don't have an accounts background?
I will let David probably answer that one if he can.
There are lots of them around the place. I don't have a list of them, but I mean, I would just Google and see what you find. There will be face-to-face, and there'll be online courses around the world. So that's where I'd be going if I had to find them.
Thanks, David. A question from Gus Collins. Thanks, Gus. In a startup company, when founders are not paid a salary, can this unpaid salary be accounted for in the accounts ongoing as debt? And if so, would this be a red flag for the board?
I don't think so, because first of all, if we're looking at a startup, and I hope I took this right, and apologies, I had to jump there because my charger wasn't working properly. It said my PC was going to shut off, so that would be bad. So I'm back now. Do you mind repeating that question again, Paul?
Yeah, no problem. In a startup company, when founders are not paid a salary, can this unpaid salary be accounted for in the accounts ongoing as debt? And if so, would this be a red flag for the board?
No, unfortunately, they can't. How that would work, from my knowledge, is effectively what is known as a terminology called sweat equity. So basically, the guys are putting their time into the business for free of charge. So unless there's actual a handover of cash, or there's a payment of cash, they wouldn't be including anything. Unfortunately, I have been involved in a couple of startups, and I've put huge hours in, and nothing has come of it. So unfortunately, no, you wouldn't be able to do that. But it's a great question, though.
Another question from Najandran. Thanks, Najandran. How far directors are liable in case of major financial concerns? Are they directly accountable for such lapses?
Yeah, David, I might ask you to come in on that one. I know from some of the cases that we have looked at on your diploma, it really depends. This is probably the hardest question that we get asked on this. But ultimately, the directors are responsible. How far that goes back, I'm not 100% sure. David, would I be right in saying it's something like 7 years, perhaps, that you could be held accountable for something like that? I know that's how long records have to be kept for.
Sorry, I missed the question.
So the question, I think, was how long would directors be held accountable for in terms of if there was a financial irregularity?
I don't really know. I think it would depend on the scale of it. I think it would depend on their behavior at the time. I mean, if they were being reckless and irresponsible, I think the creditors or the investors are more likely to go after them, either under company law or under other laws, depending on the country in which it takes place. So I don't have any timeline involved here.
Thanks, David and Sean. A question from Elizabeth Boylan. In addition to the necessity of having a competent or qualified accountant on ARC, how important is it to have a real risk competency on ARC?
I think that would be very, very important. David, you have more experience in this area in terms of the risk than I would, but I presume that would be very, very important.
Absolutely. I mean, I think it'd be great to have somebody who has worked in a risk function in an organization, or compliance and risk, be very helpful. Yeah, absolutely.
Yeah, and I think now more than ever, David, it's probably as important, or if not more important, to have a risk expert with a lot of uncertainty that's going on at the moment. So yeah, that's a great question.
Another observation question from Alex: how to spot ongoing concerns on revenue declared internally, but the customer not agreeing to the payments at all. Example, Tesco scandal from 5 years ago. Yeah,
really, really good question. I think that's really a role for the auditors. And really, you know, this is the problem. And again, I'll throw a question to David in a moment, because we usually would talk about this stuff on the course that we run. But how much information do a board actually get? That can be a problem. So if I'm on a board and the management give me the documentation, or they give me the monthly management accounts, I have to take them at face value. I have to assume that the internal auditors have done it correctly. I have to assume that at the end of the year, the external auditors will review it. But in terms of the revenue recognition, it'd be very, very difficult, I think, for a board member to get involved in that level of the accounting, because it is very, very complex when it comes to revenue recognition. And there's a new financial reporting standard that's out at the moment, IFRS 15, on that area, and you know how much you recognize at certain times. So David, I maybe you might jump in there. I think it's very difficult.
I think if a board member has a genuine concern about revenue recognition, and you know, you're not getting a straight answer, you keep on pursuing it, because as a director, you can ask for any information in the organization whatsoever. It might frustrate the CFO or others asking for basic information, but you're entitled to it. So ask for the information until you're satisfied that yes, you've got a straight answer to a straight question.
Thanks, David and Seán. Question from Edwina. What is the role of the company secretary / general counsel in financial account reporting?
As far as I'm aware, there's not really much of a role for the company secretary. I can only speak from my own experience and from my understanding of this, and David will have vastly more experience than me in a number of boards, but it needs 2 signatories, as far as I'm aware, to be submitting the accounts. They could be the chairperson and any other person on the board, which would be the treasurer. So I think the company secretary is mainly involved in the administrative side of any board meetings and submission of documentation to the CRO, perhaps. David, would I be right in saying that?
Yeah, I mean, the general counsel might have a role just from a legal perspective, that the directors aren't saying anything in the director's report that would cause the company any difficulty. They've no direct role in developing the accounts or signing off the accounts, but general counsel might, you know, throw their eye over the accounts to make sure that there's no exposure on any front for the company or the directors.
Thanks, David and Seán. For a question from Claire Percy: is a monetary value ever ascribed to a brand?
Yeah, it sure is, and that would fall under intangible assets. So pretty much within the intangible assets, I kind of made a reference to it there in the accounts we looked at, while it wasn't on that particular screenshot that we had. A tangible asset is something physical that we can see, so our property, plant and equipment. Intangible assets then are made up of non-physical things. So we look at our intellectual property, our brands, goodwill will be there, trademarks, patents, all that type of stuff. So yeah, that would fall under intangible assets. The problem is, and it's a fantastic question, you have to have a market for that particular brand, that you have to have a value on it. A company cannot generate its own value on their brand. It has to be independently verified. So some of the biggest companies in the world can have a value on their brand, perhaps Coke, Pepsi, Facebook, whoever it may be, Google. But smaller companies can't say, oh, my brand is worth 10 million. How do we know that? It's very, very, very difficult. So it's a very tricky one, but yeah, it does fall under intangible assets.
Thanks, Seán. Question from Julie. What's the best retained earnings to leave in the business when considering dividends drawing?
What's the best retained earnings? I'm not 100% sure how that. Maybe if Julie wants to elaborate on that question a little bit further in the chat, that'd be cool. But basically, guys, the retained earnings, is pretty much the profit from the accumulated profit over time. But really, after the dividends can only be paid out of cash profits, really. that we have available to us. So after we pay that out, that would be the retained earnings that will be left over. I hope that makes some sort of sense. Maybe Julie might follow up a little bit more on that if she can.
I think Julie, if you're a director of a board, you want to make sure that if you're paying a dividend, you're leaving enough retained earnings in the business to fund its future strategy. So, you know, you probably shouldn't be paying out healthy dividends if you need to retain the money in the business to fund the strategy going forward. So that's a balance, and that's a decision for the board to make.
Yeah, thanks for that, David. I think that's what she was probably referring to. So yeah.
Thanks, David and Seán. Just a general comment. You can maybe comment on yourselves from the audience. If a startup founder says they don't want to get paid, the opinion here is they'd run a mile from investing. If they don't want to have proper earnings out of their commitment to the business, would that generate some suspicion in your experience?
I wouldn't say so, and I can speak from my own experience because I'm actually an advisor on an advisory board of 2 startups, both in the financial technology space, and I'm not getting paid for it. But the hope is that one day, if these guys are successful, maybe it will work out, and that would be how you get paid. But I don't think that would be a problem, David. Would you? A lot of people would give advice, and I know maybe people who have been very successful have no problem going back and helping some small startups to get off the ground and give them advice, which is invaluable, you know.
I think it depends, you know, how long the startup is in business. 1 year, 2 years, or 3 years. If, say, in year 3, the founder wasn't taking any money out of it, and that money that the founder could take out is the difference between profit and loss, then you'd worry about the organization. You know, is it a sustainable business or not? But it, you know, if it's in pharma, it might take 5 years before it makes a profit. So I think it's kind of case specific. But you know, a lot of founders don't get paid any money for a number of years. Anyway.
Thanks, David and Seán. We're coming into the last 10 minutes, so we'll start just going through the last couple of questions and comments. I should also just say to people, because it did come up earlier in a question, and Seán will be too modest to say this, but he delivers an exceptional financial matters module on our own diploma, which is a really good, module aimed at giving board directors a whistle-stop tour of what they need to know at board level around the finance area. So that's important to note that. Coming from John, I'm on a board where the finance director provides an hour of training, an explanation every 6 months or so for the other directors. And they find it really helps understanding for those of us that struggle with interpreting financial reports.
I might just come on that comment there, Paul, because I did see it earlier on in the chat. I think that's really, really great, and it's really good governance, and it does take a lot of time and energy and effort to do that, but that's really good practice, I think.
Great stuff. So we've a couple of more questions here, and we'll finish off on these probably, unless anyone else wants to put more in. What do you believe are the key future trends in accounting and finance which board members should be aware of? So, is there any trends for this year or next year?
Really, really good question. I suppose looking at COVID obviously is a big problem, but everybody has to manage that. I think in terms of trends, financial technology has revolutionized accounting, as we know, and I think it's really important for board members to understand that. But also, you have to remember, as board members, you're not going to be an expert in any of these areas. It's important that maybe you have somebody involved in the company or organization that is an expert in that area. But for me, and it's something in an area I'm researching at the moment, and I do believe it is probably the biggest issue in business at the moment, is around ESG and sustainability. And believe it or not, and I know this might sound crazy because accountants are usually boring, but accountants have a big, big role to play in sustainability reporting, and actually who is going to capture this data. So the EU directive is set in place, and even recently at COP26 last week, we mentioned IFRS earlier on, the International Financial Reporting Standards. They have now set up a IISB, it's called. I'm not going to pretend I know what it is. It's the International Something Standards Board. It's around the sustainability reporting. So they are now coming together with a lot of other standard setters to actually make it mandatory in the future for all companies, SMEs and everything, to document their impact on maybe the environment, their social and governance aspect as well. So I would suggest that, I know in terms of committees, I believe a lot of boards, and I'll ask David his opinion now. I was on an ACCA panel in the summer with the head of IFAC, it's the International Federations of Accountants, and he was the former Chief Sustainability Officer of Unilever. And he was suggesting that in the future, all boards will probably have a sustainability committee or sustainability champion or officer. David, and I think finance, I know, and apologies for interrupting there, Dave, when I asked you to speak, but I think finance and accounting function in these organizations will have a role to play, which is exciting.
Yeah, just two things. I foresee actually boards having ESG committees to figure out, one, I suppose, how ESG can be part of the strategy going forward, or if you've just developed a strategy, you won't be able to sort of lever it in, but you might develop an ESG policy. I think from a board perspective and an accounting perspective, I think one needs to be really aware of the world of green loans, green bonds, to fund, developments in your business. And I mean, all the banks are talking about this at the moment, but I think it's really up to the CFO, the finance committee, to be aware of probably maybe cheaper loans out there to fund kind of green initiatives, sustainability initiatives, which is a brand new world. ESG is going to be a game changer for boards. It's going to broaden their perspective from what has been a narrow focus into a focus on the planet.
Yeah, I definitely agree.
Thanks, David and Sean. We're coming into, we'll probably wrap up with just the last couple of questions, and then we'll just wrap up the session. So just to focus on small companies and startups, are there more areas of concern to pay attention to, and in particular in the balance sheet with intellectual properties, which are a key part of their business?
Yeah, good question. I suppose it probably follows on from a point that maybe Claire had asked a couple of moments ago on the brands and intellectual property and intangible assets. And we know that, let's say with startups, their big thing, I suppose, is to try and generate enough intellectual property or technology that they will be able to then attract investment. And whether they classify that as, they can capitalize that or not is a big thing. So if a company is able to obtain a patent, that will obviously generate big interest in future financing. But also from the area of research and development. And this is a big area for a lot of pharmaceutical companies. Ireland has one of the best R&D tax credits in the world. Effectively, if we're looking at a startup and they're researching or developing, some of those costs can be associated with development, which then can be capitalized as an intangible asset. But if it's only research, it will go in as an expense in the income statement. So, being able to classify it or capitalize those items as an intangible asset is of huge importance. And I think a lot of startups will try their best to inflate their capitalization, so their intangible assets. And that's an area that a board or accountants would be should be really careful on, and to make sure that it's accounted for correctly, because there's a very gray area as to what is classified as a research cost versus a development cost. And there has been cases that they've inflated, their intangible assets. And I can understand why startups in particular around technology would try and do that. So I think that's a great question. And I think there is definitely differences between startups and more established businesses in terms of what are the key risks or key areas of the financial statements to focus on.
Thanks, Sean. And just the last question, we'll just to finish off and follow up on that. In relation to that question, is there certain industries that would have a greater focus on key financial areas? And just a couple of examples. Yeah,
well, I think the startups one would be a good one. I think the clean technologies now as well would fall under that kind of link, and that's going to be a big area, because there's going to be huge investment in that particular space. And are they able to commercialize this or not? I think when you look at a property developer, for example, versus a manufacturing company, property developer, it's going to be their assets really, versus then maybe, let's say, an investment manager. Well, their income is really based off, let's say, income that's derived from investments or equities or whatever it may be. So I think there are differences, and you have to be really careful in terms of, is it a charity? What are the rules and regulations? What industry are they in? Versus is it a listed firm? What are the rules and regulations around that particular company?
Great stuff. Thanks, Sean. We're just going to... Oh, sorry. Go ahead, David.
No, work away, David. Yeah.
No, just a general comment. We'll be running sessions like these, like finance for non-financial people within membership next year. So if people want to avail of the expertise of people like Sean, join up for membership.
That was a question I was going to have. Well, it's more a comment, but David, we'll have to run a finance boot camp.
Put on the list.
Yeah, thanks. We're getting exceptional feedback, Sean, to your credit. As you can see in the comments there, people have really enjoyed this hour. It's flown by.
Brilliant.
So just
Brilliant.
the last piece of housekeeping, as I said earlier, we'll make a recording of this session available for 1 week. Then it moves into our paid members area. You can get more information about membership on our website. Has a lot of practical toolkits, a lot of great learning, huge library, and access to our professional community. And there's more stuff coming in 2022. So I'd like to thank everyone for attending today. Thanks, David, for your great contributions, and particularly you, Seán. Thank you so much. And we'll let everyone get back to work today. Thank you.